Time now to spotlight Walmart and the tariff impact on the company and the U.S. economy. Joining us for insight, we've got George Seay, Executive Chairman, Annandale Capital. George, thank you so much for joining us today. Let's talk a little bit about Walmart. Look, recently Walmart gave indication that they would have to pass off some of the tariff costs off their earnings call onto consumers. Then you had the president posting on Truth Social, quote, Walmart should stop trying to blame tariffs as the reason for raising prices throughout the chain. Between Walmart and China, they should, as it said, eat the tariffs and not charge valued customers anything. I'll be watching and so will your customers. I see you smiling. What's your view on how to process all of this?
Yeah, Diane, thanks for having me on. I think it's actually pretty straightforward if you cut through all the rhetoric on both sides of this issue. Basically, Walmart has a fiduciary duty to their shareholders to maximize their profitability under every economic environment. And if the tariffs, which are economic warfare and attacks on the American consumer, continue and go through, they have to raise prices. There's no really choice they have unless they want to take much smaller profit margins and much poorer earnings results, and they have a fiduciary duty to their shareholders to not accept that. So of course they're going to pass through these price increases to their customers to some extent. Now they've got to mitigate that to some degree so their customers don't get hot and bothered about it. But every retailer in the country is facing this right now. You look at Walmart, you look at Costco, you look at Hobby Lobby, you look at so many different retailers. They're all going to be facing this issue, and the reality is, this is a gigantic tax on the American consumer. It's economic warfare, and we're just going to have to live with it. It's going to be a friction cost on economic growth, and it's going to hurt profitability of American companies, and it's going to squeeze the American consumer who's already under stress. So it's a rougher economic environment for everyone right now.
So do you feel like it's going to be a balancing act when it comes to the companies who have to obviously turn a profit and appease shareholders and the consumer? Because there's this tension, obviously, like consumers can say we're not going there anymore, like when we saw peak inflation in 2022. And that's where you saw a shift of many consumers going over to Walmart. But once they're there at Walmart, I suppose there's only so much Walmart can do when it comes to managing those costs.
That's exactly right. And if you look at Walmart, the way they performed the last several years, they're shooting the lights out. I mean, this is an incredibly well-managed American company right now. It's a real highlight for American business, not only domestically, but around the world. And the multiple on the stock has just soared the last several years, where it used to be in kind of the mid-teens in terms of multiple. It's soared as high as more than 40 times earnings because they're executing so well. And the American consumer is not going to stop going to Walmart. I mean, they're going to find better prices and deals there than they're going to find at the vast majority of other retailers. So this isn't really going to change their behavior much, but it is going to hurt the purchasing power of their income in terms of what they can buy. And it's going to create a more sour mood in the economy and less consumer confidence with everyone being squeezed by these tariffs. So that it's going to hurt everybody, and it's going to slow down our economic growth as a country.
Let me ask you this. So obviously the president was sounding off about Walmart on Truth Social, but he also mentioned China. And so we know we have that 90-day pause or ratcheting down of tariffs between the two economic superpowers. How do you assess the long-term implications of this pause on, say, global markets and just market sentiment?
Yeah, I think China needs us desperately to buy their stuff, and we are dependent on China as well to supply us with all sorts of stuff. So it's a very symbiotic relationship that we really can't extract ourselves from right now. And I think we're just facing a tough period to try to work this through properly and get things done. And if you look at our deficits, our annual deficits on the government, that's why you saw Moody's downgrade U.S. Treasury debt over the late Friday, which is affecting the markets and creating turbulence this morning. We're still running incredible deficits, and we got to make up for that somehow. And basically, that's coming from the personal income tax, the corporate income tax, and now these tariffs and all that. You got to make up for it with reduced spending or more revenue, one of the two. And the problem with the federal government is they tend to push towards more revenue, more revenue and more spending, and our deficits never go down. And if they don't go down soon, you're going to see much more pressure on U.S. Treasury yields, which pressures the economy, which sends us into recession. So there's a lot of adjustments that need to be made quickly, and I'm hopeful that the Congress can get a budget package through that cuts deficits much more dramatically, because that would be very good for the markets. And if they don't do that, the markets are going to struggle the next 6 to 18 months. This is a real transition period for America right now.
No, you make a great point on both fronts, whether we're talking about China or the issues here in the U.S. and the symbiotic relationship between the two, because there's even new data out on retail sales in China where you saw some slowing and it didn't hit the numbers that they expected. So it shows that even their recovery there is still fragile. And to your point about the deficit in the U.S., and, you know, it brings up the headline that's been really earlier rattling the market more than it is now, of Moody's downgrading the U.S. debt, and that's on concern about the rising deficit. Do you think that changes the conversation in Washington, or is it already a hot button topic?
It's not quite a hot button topic yet. I think that the career politicians in the Congress are still somewhat in denial about the fact that we've really got to shrink our deficits dramatically, or eventually the global bond markets are going to rebel and force us to pay a much higher interest rate on treasuries, and that will exacerbate the deficit situation. So we're in a sticky wicket, as the British like to say, but so are the Chinese. Their economic growth is pitiful, and they've been an export economy, and we're trying to move them more towards a consumption economy to balance the trade deficit much better. And unfortunately, we've got communist leadership, totalitarian leadership in that country, which doesn't really fully appreciate or understand capitalism or how world markets work. And they're very resistant to do anything but what they mandate to the rest of the world. And they're going to have to learn to compromise, or we're going to have a lot slower economic growth and a lot harder economic times globally in the future. And hopefully the Treasury Secretary and other economic leaders in the government can bring them to the table and get something constructive done for all concerned, because it's going to affect the entire world, not just China and the U.S.
No, you make a great point, but I got to ask you this in terms of, you know, the gains that we saw last week and the pressure that we initially saw on markets. You've got some of that pressure coming off right now. Do you believe investor sentiment is shifting towards a more optimistic outlook, especially, you know, we bought some time with regard to trade policy and negotiation on that front. And the idea is that we'll probably get some kind of agreement within those 90 days. Is the optimism warranted, or should caution still be the view?
Yeah, that's a great question. And, you know, I think some people have jokingly referred to the markets as bipolar or manic depressive. And it goes from periods of euphoria to periods of deep grief and back and forth and up and down. And we're in a period of deep grief only about a month ago, where the market's really cratered in a very short period of time. And now we've rallied tremendously up there again, and we're at close to historic highs on price per earnings multiples. And at the end of the day, the market's going to be driven by earnings growth. And if we have a lot of tariffs and a lot more taxes on the American consumer, and we cut back on federal spending, you've got a lot of brakes on economic growth, which are going to affect earnings, which means we're paying a very high price for corporate earnings right now. So those are a lot of headwinds from the market. So are we going to just euphorically go up another 20, 30% here in short order? I don't think so. Are we going to fall off a cliff? Probably not. The economy's been extremely resilient, and we're kind of in a workout period right now that I think it's probably going to take another 6 to 18 months before we get a more firm direction, whether the market can continue its upward trajectory or whether it's going to have a rough patch.
No, you make a great point, because there's that divergence between the hard and soft data. The hard data has been still holding up, but you've had that drop off in sentiment data. And this time around, many economists say it's probably going back to return to how it originally was, where it was a leading indicator essentially before the hard data. We saw some weakness in the hard data, but we shall see. George, great conversation. That's George Seay, Executive Chairman, Annandale Capital. Thank you so much for your time today.